Hi, I'm Michael Christensen. Thanks for watching my video for this week. This is the weekly market update for the week ending Friday, March 15th, 2019. Before I jump into the charts and commentary, I'd like to wish you a happy St. Patrick's Day weekend, whatever you plan to do. I have a friend coming over and we're going to make 15 gallons of IPA homebrew on Saturday, and that'll be ready just in time for summer. So I figure what better weekend to make a batch of homebrew than St. Patrick's Day weekend. So that's going to be a good time. Thankfully, the weather's getting warmer, and we just got done with a little blizzard here in Loveland, Colorado. Jumping into the commentary of the stock market, for the last 2 weeks, the stock market has been very quiet. And last week, the market dropped 1 to 2.5%, depending on what you're looking at. This week, it bounced back to where it was last week. Didn't make any progress, but this week is what we in the financial services industry call quadruple witching day on Friday. That is when 4 different investment products expire at the same time, at the same day. Futures, options, options on futures, all kinds of stuff, derivative products that people buy, and they have a finite lifespan, and they are all expiring tomorrow. So I anticipate that Friday this week we'll have significant trading volume, which often happens on options expiration day, but it is extremely high on these quarterly dates that we call quadruple witching. I don't know who coined that phrase, but that's just what they call it. Now, talking about the stock market, we are still stuck exactly where we were last week. We have the mid-October high in the Dow and S&P 500, mid-October, November, and December high. And the market is just kind of stuck. It doesn't want to go anywhere. And the Russell 2000, which is an index of small companies, is starting to roll slowly to the downside. It is the weakest of the bunch. I'll touch on that briefly in this week's video. But I would say continue to use caution, because last week we had a jobs number for the month of February that was absolutely abysmal. In February's number was like 300,000. They were expecting 180,000 jobs created in February, but we came in last Friday with only 20,000 jobs. Now, some people are thinking that it was probably blamed just on weather because of the polar vortex and all that stuff that froze the death out of everybody in the Midwest and northern states. And that is certainly a possibility, but we have continued pressure in corporate earnings, and we have the new home sales numbers came out on Thursday this week, and they were continuing to get weaker year over year. And so I would just say that almost all of the economic data that I'm seeing is toward the downside or weakening. And that's not a sign of a strong bull market environment for stocks. Yes, we had a very huge rally since Christmas, but don't get too complacent after just 2 months of a stock market rally, because it is looking to me, as well as others, that the remainder of March could be the return of volatility in the stock market. And remember what Warren Buffett always likes to say, and that is, be fearful when others are greedy, and be greedy when others are fearful. And right now, everybody's getting pretty greedy after that Christmas to March 1st rally. So I would recommend that take a little less risk in your investments. See where we go the rest of March. As I always like to say, the best way to make money is to not lose it in the first place. So with all that being said, and that caution being advised to you, let's go ahead and jump into those charts. And we'll begin with the Dow Jones Industrial Average, and then I'll do the S&P 500, and this week I'll do the Russell 2000 Small Cap Index. Before I do, please click the subscribe button if you're watching this on YouTube, and click the little bell next to it. But if you're watching this on Facebook or LinkedIn or Twitter, just go ahead and like or follow the page of Christensen Wealth Management. I would greatly appreciate the the thumbs up and the likes. It would be very, very kind of you to do that. All right, let's look at those charts, beginning with the Dow Jones. This is a one-year chart of the Dow Jones Industrial Average showing the peak here in October and the bottom down here on Christmas Eve and the day after Christmas, and this big rally that we've had ever since Christmas, which has been absolutely euphoric in nature. And according to Lance Roberts at realinvestmentadvice.com, this rally that we've had since Christmas is the steepest stock market rally in 70 years of recorded history. That is very abnormal that something like this can happen. And that is what gives me a lot of caution and concern, because of the fact that rapid drops like we had here from December 1st into Christmas are often followed by rapid surges in the stock market, and rapid surges in the stock market are often followed by rapid declines. So we'll just have to wait and see if that decline materializes. But what I can tell you is the trend line is broken as of right now. I'll draw that in for you right here. This blue line, which started on December 24th, Christmas Eve, was touched a second time right here on February 11th. And then we had February 14th, February 21st, and then we finally broke that trend on February 26th, fell down here to this small short-term low here on March 8th, and then caught a little bit of a bounce coming into today on March 15th. By the way, this video is being recorded during the market hours on Friday the 15th, so trading is currently in progress, and as of right now, there is very little change to the Dow Jones Industrial Average at the moment. But the trend line is broken and we started to fall back to the downside. We also ran into some resistance, which I'll show you right here. These two highs right here, this one from October 16th and this high from December 3rd. I drew a blue line across the top of both of those, and you can see that we fell back below that on about March 5th, and we have not been able to get above those December and October highs since then. And right now, that's what these blue circles represent, just the peak of those 2 months. And then now the Dow is currently struggling to try and get back above that, and we just need to wait and see if that's even possible. I don't think it is, but I always believe in trade what you see, not what you think, and right now I just use caution because we are slowly rolling over to the downside and losing strength in the Dow Jones. This is a 21-year chart of the Dow Jones Industrial Average, and I'm showing you this to illustrate the 10-year trend line that we are currently riding and is still supporting this market. And let me go ahead and draw that in real quick. You can see this trend line began in March of 2009. We made the second point in January and February 2016. And we came right down from October until Christmas Eve this past year and just tagged that line and bounced right off it one more time. What gives me some concern, though, is that this is a 10-year trend line, one of the longest in history. And if this blue line is broken, there's not a lot of support until we get down to much lower levels, which I'll illustrate right here. This red dashed line represents the highs of probably February 2015 right here, right there, and the lows going into the November 2016 election right there. And there's not a lot of support below from where we are now until we get down to there, except this blue 10-year trend line. So we need to watch this trend line very carefully, because if it gets broken, then there's a very good chance that we're going all the way down to the red line. And let's see how much of a percentage decline that would be. If we made that drop from where we are today on March 15th all the way down to that red line, that would be a decline of 29% for the Dow Jones Industrial Average. And that would be extremely unsettling for investors, maybe yourself as well. And so if I can help you in any way, keep track of this stuff for you and help you with your investments, please let me know. Let's go ahead and take a look at the S&P 500. Here's a 1-year chart of the S&P 500 large cap stock index, and I'll fly through this one a lot faster than the Dow because they look very similar. We had the big drop, the big post-Christmas rally, and now the trend is broken and we're running into resistance in very similar fashion. I'll draw in that trend line real quick. There's the blue trend line right there, and we broke it the end of February, came down the first week of March, and we have rallied up and got back above the high of it looks like about March 1st over the last few weeks, and now we're running into resistance in these 3 highs just like the Dow. Let me draw in some lines there. So you can see this week we rallied back up off of last week's low and touched the October high, which is right there in the blue circle here, which was October 16th and 17th, and then this high right here, which was November 7th. We are currently sitting right on those lines as we speak, Friday, March 15th, and we'll see if we can get above those two. But right now, it is very difficult for this S&P to break free of that. So use some caution going into next week until we get some clarity. If we can get above these 2 highs with some strength, then hey, maybe we're going to all-time highs. But right now, we're just kind of stuck and going nowhere for the last several days. Here's a 20-year chart of the S&P 500, just like I showed on the Dow. I'm going to draw in a 10-year trend line to show you what that looks like, because it's much more bearish or weak than the Dow Jones, which hasn't broken the trend line. The S&P 500 has. To illustrate that, I need to change this over to a candlestick chart instead of just a basic line chart like you're seeing. So let me change it to that candlestick chart and draw in the trend line for you. The advantages of a candlestick chart is each increment, in this case 1 month, shows me the high, low, open, and closing price of this particular index each month. And if I draw a line from the lows of March of 2009 to the lows of February 2016, and I project that on up, you can see that we broke that in October of this year, or of 2018 that is, and we rallied back up since Christmas, and we tagged that in February last month, but didn't break it, and we're touching it one more time as we speak. So this is a potentially negative situation where we broke the trend and we're rallying back up to touch the trend one more time from underneath, except the problem is that this blue line, this 10-year line, that once was support for this market has been broken, and now it is resistance. And resistance means that it's going to be very difficult for this market to get through on the S&P, and I am watching to see if it runs out of gas and starts to fall back down to the Christmas lows. So be careful at the moment, because right now this is a common bearish negative setup for the stock market going forward for the next several weeks to months, and we just need to take it 1 day and 1 week at a time. And the last chart of the day is this chart of the Russell 2000, as I mentioned I would talk about. It's the weakest of the bunch. It's the farthest from its October-September highs, and we've gotten back above the December high right here, but we are a long way from the November and mid-October highs right there. Let me go ahead and draw in the trend line and the resistance levels just real quick. So this diagonal blue line right here is that Christmas trend line, and it was broken the last week of February, and we dropped really hard down into last week, and we've only rallied back about halfway of last week's move to the downside. So right now we're sitting right there, and these 2 horizontal blue lines are those highs of late, or I should say mid-October and November, and those are the 2 that are putting up the biggest fight. It also coincides with this high all the way back here in April of 2018. So there's a substantial amount of resistance, mostly at this November high right here, and you can see that could be why the market rallied up, popped its head up above that, failed, tried again, failed, tried again, failed. So it's tried 3 times to get above the November high, and it's failed all 3 times, and now we're stuck down here. So keep a close eye on the markets. There's a lot of indecision and just not a lot of strength going on here, other than the fact that we've had a nice Christmas rally, and we may have a pullback of some size, but it could also be one of dramatic size, of all the way back to the Christmas lows perhaps. So right now, just use caution. That's the word of the day. Thank you again for watching. Before you go, remember my other quote that I like to say, and that is, getting back to even is not an investment strategy. I highly recommend in these volatile times that you take less risk with your investments and only invest when things look favorable to you. If they don't look favorable, don't invest. Nobody ever said that you have to be invested 100% of the time. And at Christensen Wealth Management, I believe that very strongly. I chose to be an independent financial advisor for many reasons, but one of them is to have the freedom to seek safety in stock market turmoil. And we may be about to see that again in the very near future. If I can be of service, please let me know. I would sure enjoy talking to you about your investments, your 401ks, your IRAs. And if there is a chance to talk to you about the one financial problem that is really holding you back from succeeding in investing or in just saving or raising an emergency fund or whatever is the most important financial need in your life, I would like to help you do that. So give me a call, and I would enjoy getting together with you for a cup of coffee or lunch or something like that. You can reach me on my social media pages, by email, by phone. All of that information is on the slide at the very end of this video, as well as all of those places that I just mentioned: Facebook, LinkedIn, Twitter, etc. Thanks for watching. Have a great day. I'll see you again in about another 7 days. Bye-bye.